Hello, I'm Kim Stafford, and I'm here again with PIMCO Group CIO Dan Ivascyn to give you an inside look at some of the recent discussions taking place within PIMCO's Investment Committee, or IC. Thank you for joining us, Dan.
Thanks, Kim.
The Fed has signaled that it's likely done raising interest rates, but it may take some time to cut rates until it has more confidence in the future path of inflation. What are the key implications for investors as they're weighing the outlooks for bonds, stocks, and cash?
Over the long run, we do believe that the fixed income value proposition still holds. After the sell-off that we witnessed in 2022 during a portion of the last year, we're at valuations that are nearly as attractive as we've seen in well over a decade. So from that perspective, bonds look quite attractive versus equities. They also look to be at levels where investors will be rewarded for shifting from cash into high-quality fixed income. But in terms of Fed cuts, after the significant rally we saw last year across markets, we do believe that markets got a little bit ahead of themselves anticipating early cuts and significant cuts. The data has been mixed, inflation data more constructive around the globe, but particularly in the United States, we've seen a lot of growth momentum. Strength in just broad growth, strength in labor markets, even continued strength in housing markets. So we do think, although the inflation picture is improving, the Fed's going to be patient. They're going to want to see more progress on the inflation front or signs of economic weakening, or they're going to stay on hold, and they very well could stay on hold for quite some time.
So the Fed is keeping rates elevated for now. What do elevated short rates imply for the investment opportunity set?
In terms of sectors, again, similar dynamic. Consumer sectors, key segments of the corporate sector, investment grade and high yield borrowers, in many cases, we're able to lock in very, very low rates. They don't have significant maturities coming for the next few years. But there are areas where we're seeing already a lot more rate sensitivity. Segments of the commercial real estate markets, the senior secured loan space, the private credit markets are almost entirely floating rate. In those segments of the market, particularly lending tied to weaker corporate entities, weaker property types, we do expect to see more strain and stress if rates stay higher for longer and we don't get more immediate rate relief that markets were at least romancing late last year. That's going to create some challenges, but also significant opportunity for end investors as well.
In our 2024 outlook, we said that opportunities in global bond markets have been the most attractive we've seen in decades and could even outperform U.S. markets given greater economic risk. What are some of our favorite global opportunities we're seeing today?
Global bonds are back. We've seen with the sell-off in rates around the globe and more economic fragility in some key areas of the opportunity set, not only attractive yields, but prospects for positive price performance as well. Economies like the United Kingdom, Canada, Australia, even segments of continental Europe. So we do think, at least on a relative basis, the longer rates stay elevated, the more potential risks to those economies that I just mentioned that can create attractive opportunities for high-quality bond investments. So we do think investors should think about global investing. Higher quality emerging markets look quite attractive as well. And then because we're not out of the woods yet in terms of central banks being able to engineer a soft landing, we do think that investors should stay a bit up in quality, focusing on some of the higher quality, at times a bit more complex segments of the bond market. We really like agency mortgages. We really like asset-backed securities. And then within the corporate areas, the fixed rate markets, up in quality tilts and investment grade on a global basis, even high yield corporate bonds, up in the higher rating categories look attractive to us as well. Then there's going to be some great opportunities across private markets. This repricing is occurring very slowly in response to higher rates. If we do get some economic weakening later in the year and elevated policy rates remain, we're going to see very attractive opportunities in deploying new capital across key segments of the private credit markets, including real estate. So, here today and now, I take advantage of the higher yielding, higher quality segments of the market, expand outside the United States if you have the flexibility to do so in some of those higher quality markets. Diversification is back in bond markets and should be beneficial to returns. And then in the private segments of your opportunity set, be patient, but get ready for what we think will be some of the best vintages or vintage returns that we've seen in a very, very long time.
Well, thank you very much, Dan. And thanks to all of you for joining us. We'll see you next time.